So yes, we are live now, and I think we can start the session. So welcome back to the second part of the Rupee series that we're hosting at the Fast Food and Cafe Virtual Expo, which is powered by ETOS. We have with us Mihir Mehta, the Senior Vice President of Ashika Capital, to give us an understanding of what is the difference between value and valuation. And post our previous session that we had on the different critical risk factors that one needs to understand as far as financial and non-financial institutional buyers go. Now, we are looking forward to the session here on value and valuation, and over to you now.
Thank you, Mini. I hope I'm audible. Hi everyone, good afternoon, and thank you for joining in. It's I was just telling Mini before we started that it's a little funny to do sessions virtually because you are not able to gather facial cues or how the audience is looking at you. But I think Mini rightly put it. That's the world we are living in. So can't really complain. But yeah, so thank you so much for joining in. And before we start and before I talk about value versus valuation, or a little bit more about valuation, because that's one of the things that we as bankers, or at least in my experience, have seen. It's always been a debatable question. So before I start, I just wanted to give out a few disclaimers so that you know what are you getting into. Please don't drop out at this point in time. These are just simple disclaimers. So the purpose of this session, honestly, is just to give you an overview or some thoughts when you're looking at a valuation or when you're looking at harnessing value for your business. So, when you're raising capital, as we had spoken about the last time, when you're trying to raise capital, one of the critical questions that you need to answer as an entrepreneur is how much, what should be my valuation? What should be the business's valuation as of today? And how do I know it's fair and it's just? So that's something that we are going to touch upon. Another thing is that, as I said, it's a very brief presentation. So I would request everyone to make it more interactive and put in your questions, whatever you might have. I will try and answer it to the best of my abilities. The idea is that we talk about different aspects of valuation, how we are doing our business while we're conducting a fundraising exercise rather. The third thing is that I've made use of a lot of pictures in my presentation. I love memes and cartoons, so it's always good. So with that, I would just go ahead and share my screen. Okay, Mini, you may have to give me access to share my screen. Mini, hello. Mini, can you give me access to share screen?
Just a second. Yeah, just a second.
Thank you. Okay, I can.
Yeah.
Just 1 second. Okay, here you go. So value versus valuation. And, as the picture very clearly states it, I think valuation is a function of multiple aspects. And when we are talking to entrepreneurs about valuation, they're talking about, how my revenue is, this is my business model, my brand, and so on and so forth. So, let's try and talk a little bit more about how we think when we look at valuation and eventual goal. If today, if you're trying to raise capital and if that's the goal you're trying to achieve and you do need the capital to invest in your business, while valuation will be a critical question, it should be a means to the end. And I mean, it should eventually result in some sort of, possible transaction. So as I was mentioning, I'm a big movie fan and I love images. So, before we start, an Avengers Endgame happens to be my favorite movie as well. So I'm not sure if you might have seen this, but this particular quote, and again, please note that I'm not certain if Mark Cuban has said it, but this particular image had been making rounds of social media networks for a while, which says that 60% of a watermelon is better than 100% of a grape. The reason I start with this particular quote is because when an entrepreneur is looking at the business and they're looking at, okay, this is what we've created and this is what there, I mean, there is a potential to create more, but a lot of times, the stake that you hold in your business is critical, and yes, it should be, but that becomes a moot point, and eventually you're unable to progress when it comes to raising capital. And that's where I think this kind of sets the tonality for this brief session, wherein um, you know obviously if you own 60% of a watermelon, owning 100% of grape is obviously less valuable than owning 60% of a watermelon. Uh, Obviously no guesses, but no prizes for the guesses. But the next quote, which also says business happens over years and years. Value is measured by total upside of the business and not by how much you squeezed out in one deal. This is extremely critical for you to note, and this obviously again, as per the internet, has been said by Mark Cuban. But the reason this is important is because a lot of times, as business owners or as entrepreneurs, we're looking at what am I getting out of this deal or what am I getting out of this capital raise. Without and in those times, the larger picture takes a backside, or larger picture doesn't come up, and hence it's important that you focus on what the big picture is as well. I'm not sure if the nation wants to know, but I'm sure founders ask for questions like, if it's my first fundraise, how much stake should we dilute? What should be the ideal valuation for my business? If the valuation assigned to my company is not desirable, should I not raise capital? Again, going back to my first statement, wherein I mentioned that valuation or dilution of equity is a consequence of your business plans, right? So today, the eventual question is, do you need the money? And if you are wanting that capital, obviously you have to give in some equity. It should not, in an ideal scenario and or in an utopian world, it should not become a deterrent to raising capital, because eventually the idea is that you invest that capital and harness the value of the business as you move forward. So when I was mentioning to many that I would like to talk about valuations and value, and value versus valuation. To be honest with you, obviously, there's not, there's no significant difference between what value is and valuation is more like a process. But the reason I called it value versus valuation is because, the idea was to give you certain thoughts or share certain thoughts wherein you are able to think about value more than just the process. So it is about reaching that particular value that the business holds, and not really just worrying about the process as to how are you reaching that. So the reason valuation is extremely critical and should be also, and for a few seconds, please ignore that interesting poster which may give you a lot of brainwaves. I will come back to that. But one of the reasons valuation is extremely critical is because that allows you to figure out what's the kind of stake that you should dilute, and especially when we talk of companies trying to raise capital for the first time, it's a debatable question, because when you're raising capital for the first time, obviously there are considerations like, what if the business does not pan out as we've envisioned, or am I not getting the value because I'm too young as a company or too young as a business? Should I dilute, X, Y, Z percentage stake, and so on and so forth. When you're thinking of these aspects as an entrepreneur, and this, I'm assuming because the audience is more, founders and entrepreneurs who've joined in, it is critical that you take certain factors into consideration when you are thinking of stake dilution. So stake dilution obviously is a function of what kind of valuation are you receiving, or what kind of value are you receiving for your business. But multiple times we've seen entrepreneurs and we've seen businesses give away a large chunk of equity in the initial rounds, thereby leading to a state where you have certain requirements in the future, but because of the position that you've put yourself in, you do not have enough hedge to dilute further equity and so on and so forth. The idea here is to avoid making deals or conducting transactions or raising capital in a fashion which eventually jeopardizes your future trajectory. And hence, it is extremely important that when you're trying to raise capital, and this is a common thing that I do ask entrepreneurs, and they always tell me that, okay, look, I'm gonna raise this X, Y, Z, whatever, like X crores today or X million dollars today, and this is how my business will pan out in the next few years. And the next question that I ask them is, so when do you plan to raise, capital the next time? And they're like, maybe once we run out of capital right now, and that's a very obvious answer, obviously. But it's important to plot it out. It's important that you understand what your future company trajectory is and what kind of further capital will you require and in what timelines. That allows you to fathom that, okay, these are the possible valuation scenarios, which is the next point. If I'm going to conduct my next round raise, or if I'm going to raise capital say in a couple of years, uh, so sorry, I just got distracted with the message. It was to maximize the screen. I think this is the one. Okay, I hope this is better visible. So yeah, so the idea here was that how do you think about raising capital? So when you're plotting this future trajectory and when you're plotting as to when will you require capital next, what you're actually doing is that you are figuring out in 2 years from now, if I'm going to raise capital and if I'm at this particular scale or some other scale, as we discussed in the last session, you always conduct multiple scenarios. It's not always going to be that your business performs as you've planned it to perform. So if it if there's a pessimistic scenario or an optimistic scenario, how will my valuation turn out to be? And if at that point in time I'm supposed to raise another XYZ million dollars, what is the kind of stake I may dilute? And that gives you a certain understanding in terms of how the trajectory will be, because your business and your fundraise, please note this, your business and your fundraise will not end with the first fundraise that you do. Another critical point, or crucial factor to consider is requirement of minimum capital. This is important because a lot of times when founders are raising capital, obviously the idea is that we raise capital so that we are able to grow faster and we're able to scale and so on and so forth, build that business out. However, at least in your initial phases of raising capital, or even I would say even if you've raised capital earlier, it's important to know that from an operational standpoint, what's the minimum capital required, so as to ensure that you are able to either justify your infrastructure, justify your team strength, or whatever that resource is. And that kind of gives you your threshold that if in a case where the valuation or the value given to you is not desirable, is there a possibility to control stake dilution by reducing the amount of capital that I require? And obviously, the last question is, or the last factor is, how can you build value with the capital and adoption of measures in order to build an efficient capital mix? So obviously, a lot of times we also, encounter situations where entrepreneurs tell us that, we need this kind of capital because this is critical for the business to at least build that product or build that distribution, or at least go to market in a particular city, geography, however it is, whatever your objective is. Um, Again, from a stake dilution perspective, and in order to ensure that stake dilution is limited, whereby you have enough equity at your disposal when you're raising capital further, you can look at different sources of financing as well, if there's a possibility. So we have in the past obviously recommended that you can look at debt capital, or you could look at some sort of um, bridge capital or some sort of, again, source of financing, which is not exactly leading to dilution of stake. Now, I'm not too sure if there are investors or if there are potential investors in the audience, but the reason I put that special 26 poster up is because, um, again, I think this is where my a little bit of my CA knowledge kicks in. But one of the things is that under Companies Act, and this is something that we do tell entrepreneurs just so that they understand the the picture, and I mean, so they know all the aspects. That let me put it that way. Is that for certain matters like alteration of articles, alteration of memorandum, issuance of shares, um, appointment of auditors, there are special resolutions required under the Companies Act. Now, special resolution is generally when you have received 75% vote from the shareholders in the AGM. And hence, what we say is that today, if this shareholding is split in a way where you own less than 75%, so say 74 and hence 26. So if there is if there's an investor or if there's another stakeholder who owns more than 26%, so their say in terms of the special resolution becomes important. And obviously, from a voting perspective, it may so happen that if you're trying to clear a special resolution, it may, not go through or go through, however it is. But this is something where, again, something that you should know. It's more like a piece of information that needs to be known to founders when they're using capital. Demystifying valuation. Value of a business is matter of perception. So yes, I think every transaction that I've possibly looked at in my career, or transactions that I've looked at anyways, the the debatable point, or the point where um, you know discussions happen, is value, because again, it's a perception. So if I look at, if there's a transaction where there are three stakeholders, which is the founder, the advisors, and the investor, there are definitely going to be three different points of perception and the way they look at a particular business. Hence, it is rightly said that it's an art and not a science. But when you're trying to, and again, you may get expert help in terms of sorry, conduct of valuation. But as an entrepreneur, some of the things that you should definitely know, or you should definitely think about, are first and foremost, obviously, when you're trying to value a firm, you're trying to understand what is the value that this business can generate over a period of time, and hence you're raising that capital, and hence you're going to deploy it and harness that value. So constructing that business model, this is very critical. And again, when you're trying to plot numbers, and please don't be afraid of numbers, which is again a concern that we see. But when you're trying to plot numbers, or when you're at least trying to plot your business out on a paper, more often than not, we see that it's you know the way it's projected, or the way people talk about businesses, it can be a it can either be a top down or a bottom up approach. What we mean by this is that either you're going by the dictum that here's my addressable market and here's how I'm going to capture a particular share of the market, and that's more like a top down approach, so that you're determining how your business will turn out in terms of revenues and in terms of other financial. Or else you're like, okay, this is what I've done in the past and this is how I can grow. So these are my numbers, and I know that I can grow, say 40, 50, 60, 70%, or however it is, because I'll be raising capital and I'll be growing faster than the industry. Whatever approach you take or you undertake, please ensure that you are able to justify to you. So forget the investor. I mean, you should be able to justify it to yourself. There are times when we encounter business models where people talk about, very interesting growth rates, and when we, break it down, the arithmetic doesn't, work out properly. So it's important that you are thorough with what kind of approach are you adopting, and you can justify it. I think something that we discussed the last time as well, building in sensitivity in different scenarios in the business as an investor would do. This is again pretty critical because we as founders may think that okay, this is how the business is going to pan out, but eventually there may be different scenarios that the business may pan out. Like today, if I'm thinking, okay, my business would do X amount of revenue, it may not be able to do X. It may be at X minus or X minus minus or even X plus. It's important that you take that sensitivity into account and you value the business in different scenarios because that's what ideally would be the exit point of valuation for an investor. Deriving fair valuation and adopting benchmarking mechanism. Yes, so this is again quite critical because when you're valuing, so today no business or no entrepreneur exists in isolation. Maybe a wrong term to use, but right now, but um, you know, there are either businesses that are constructed in a similar fashion or in similar industry XYZ, which obviously we call them peers. It's crucial that when you're trying to value your business, your brand, and again, your business may be a function of your brand, that you're adopting benchmarking mechanisms. So you are understanding how, say, if there are certain transactions that have happened in the past, how have they taken place, and what kind of valuations have they received? Because that gives you a fair bit of range and indication that this is how industry, so today if I'm a consumer business, say in fashion, um, it would do good to me to see how other businesses in the same domain have been valued because that gives me a certain landscape, that gives me certain understanding of how third parties are viewing this industry. And obviously, I may be an outcast and get a better valuation, or unfortunately, worse valuation. But having that sense of the landscape you're dealing with is extremely critical. Again, when it comes to, I think, consumer businesses, and because we work with a few of them, one of the I wouldn't say complaints, sorry, concerns has been that the valuation does not fairly account for the brand equity that we have built. This is something that um, we encounter as a question, or I'm sure founders also question themselves that look, I have built a solid brand. There are people talking about this brand across the country or across different geographies and so on and so forth. Um, there's a lot of buzz I have built about this brand, but does my valuation, so today if I'm getting an X value and whatever I'm assessed at, does it take into account this brand equity? Well, see, this is a, again, this is a subjective question, or rather, the lens to look at it is first and foremost, what a founder should look at is that how does this brand equity help you score brownie points? Now, it can be in terms of garnering better demand, it can be in terms of garnering better realization, from the same target segment where your peers are playing in, or it can be, in terms of cost structures. So, however and whatever, like today, we've seen businesses where even in F&B, and without naming anybody, there are certain brands in F&B who have better, in the same space, have better marketing to sales ratios. So what it means is that for every buck spent on marketing, they derive better realization in terms of revenue because their brand equity is high. So those are aspects that you need to define first. Exactly what does your brand bring in for you? Um, Once you have defined that, maybe you can again, as I said, it is subjective as to what should be exactly the value of that equity. Because today, let me just give you a very simple example. If you're covered by, say, 20 newspapers for a brand launch that you've done, or there's a lot of buzz, now how do you convert into revenue, and what is it that exactly this brand equity brings to you? Once you figure that out, I think accounting for that, again, there are various methods. I'm not going into those methods, but there has to be a way to account for that additional or better than industry or better than peer attribute, wherein that brand equity factor comes in. So before you conclude that the valuation does not take the brand equity into account, it's important to understand what does this brand bring to you. Again, excuse me for the cartoons, but I love them. There's a famous saying which says there's no smoke without fire, and absolutely true. But similarly, there's another saying that there are no rewards without risks. I think this is an important point that I want to communicate to founders that when an investor and when you're in a possible fundraise scenario, any investor is obviously partaking in the possibility to generate rewards, but uh, as much as the entrepreneur does, he or she is also bearing the risk of that business. Um, there are times where when we again speak to founders, we realize that businesses obviously are meant to be run in order to reward you, in order to reward your stakeholders and everyone. However, um, when investors are entering a business, or when someone is providing financial capital, which is also a form of capital, while the entrepreneurs bring in the business acumen, the human capital, and they run the show. Financial capital is an important ingredient in ensuring success in a business. So they are assuming certain risks, and that risk is losing that capital, and there's an opportunity cost attached to that capital. So what we should obviously as founders, um, and even obviously investors do understand it, but I think it's important to factor in risk scenarios in the business when you are thinking about how is your business valued. um, as everyone wants to look at a rosy picture, and there's no denying that, but you can't leave out the risks, and those risk factors need to be equally given importance and valued when you're determining the value of the entire business. Well, these are not technical jargons. If you're thinking that, you don't think that. These are very simple jargons going from WIIFM to WIIFU. Um, as I said, because this is not a physical session. If it was, I would have asked someone to help me with this, but let me give it to you. So, what I'm trying to say is that we have to, again, from an entrepreneur's perspective, it has to go from what's in it for me to what's in it for us. When I talk of what's in it for us, it simply says that in a case where you're trying to conduct a transaction, again, from my experience, I can tell you that there are entrepreneurs who said, if I give my business for this value, then maybe it's not justified to what effort we've put in. Mm, the concerns are like, okay, I have given so much time and effort to this business, and how can I just give it to someone who just comes in and has not really given that kind of effort into the business. But look, today, obviously, when an investor or anyone who's coming into the business, uh, they are, as I said in the previous slide, they're assuming certain risks. Now, yes, it is important to think what's in it for you, but it's also important to think where will this capital lead you to, and how you as a founder, or how the entrepreneur along with other stakeholders will be able to create value in the long run. In that case, there are some critical questions to consider. I think the first and foremost, and I had mentioned it in my last session as well, and I would again reiterate, is that what could be a realistic valuation of the business at the time of potential exit? And this is critical because that kind of determines what kind of entry point should be legitimate or should be ideally viable at this point in time. If as a founder you're not thinking about how your business will pan out and what would be a potential valuation, I mean, again, you have to think of how realistic it is, can be, it's very difficult to really debate on what the entry point should be. And once you kind of plot that out, you yourself get a sense as to how the return profile or how this entire journey will be. What would the business trajectory be and value be if I do not invest capital? This is one another thing that I would definitely, and I mean, I would strongly recommend is that you should also look at how your business will pan out if this capital was not invested, and try and plot it out for, say, the next 5 years or 3 years, like for whatever period you were going to use that capital for. If you do not really see a value enhancement that is that comes in as a result of raising this capital, then well, I mean, maybe there's no point of raising this capital. But if there is a significant value enhancement that you see in terms of business, in terms of your own stake, um, obviously then raising capital is warranted. So it's important that you do not just think about, okay, if I were to um, raise this capital, give this much stake, what would happen, and so on and so forth. But also think on the flip side that if you weren't going to do this, what would happen? Will the potential exit reward the exit reward the investors and myself for the risks undertaken? This is again extremely critical. You are gonna, obviously, as a founder, a founder puts in hard work, effort, and obviously there's an opportunity cost attached to the time invested in the business. Uh, and that's from an entrepreneur's perspective. But from an investor's perspective as well, there's an opportunity cost, the capital that he or she is invested in the business. Now, when we talk of that, it's important, and again, going back to my previous slides and my previous talk last Thursday, it's important to plot this return profile out. Once you do that, kind of understand that, okay, if, like, for instance, if the return profile is not extremely attractive, now there are two options. One is that, again, I'm not asking you to design numbers like a magician, but from a realistic perspective, one is that, has, like, have I captured all the scenarios, and is this the best that the business can deliver? Then in order to make it attractive, sorry, then in order to make it attractive, um, should the entry point be different for the investor, and then it makes enough sense for the investor to get into the business. So hence, it's important that you plot this entire journey and also figure out what kind of return profile are you offering to the investor, which is the next point. As I said, there's an opportunity cost to the capital attached. So today, if an investor is investing $100 in a business, which could be invested in some other asset class, there would be some sort of a return profile. Now, you know, you all obviously, if I'm taking this risk of, kind of an unlimited downside. So if it's an equity investment, it's almost an unlimited downside, right? If I am taking that kind of risk, am I being rewarded, and is the return profile attractive when I look at less risky asset classes where my capital may be protected and there is limited downside and so on and so forth? Obviously, how will this capital help me enhance value of my business over time? Back to my first slide, larger picture. Sorry. Eventually, value building is a process in time. So it's not about just one transaction. It's not just about 1 year of operation. It's not just about, one at a particular moment. You're going to build it over time. So if this capital helps you build that, then obviously it makes sense. If it doesn't, and if there's, as I said, if there's no significant increase, or there's no significant value enhancement, um, maybe then you may have to rethink and revisit why you are raising capital and what are the reasons you're doing this. I think the last point, because it's in bold and I've intentionally kept it so, is that what are the other benefits that will ensue to the business as a result of this capital raise and as a result of the incoming investor? I think, and this is what we define as intangible benefits. I'm sure a lot of times investors speak about this. There are a lot of intangible benefits that accrue in addition to financial capital that is provided by a potential investor. So, sometimes, and I do tell entrepreneurs that as you may be thinking of, certain intangibles that you bring as a business, because as I was telling about brand equity, now today, you know, as I said, it's very difficult to give a particular number to the kind of, traction my brand has built. Similarly, from an investor's perspective, there are other things that they bring to the business. Maybe it's strategic direction or insight, um, help with management bandwidth, and etc. How do you, so as an entrepreneur, you should always look at those things as well when you're debating the valuation, when you're thinking about the valuation, because again, from the other side of the table, that's something that may not have been captured in the valuation of the business, because that will unravel, or that will be seen only once that comes in. So today, if as an investor, for instance, I mentioned to you, and I think same goes for both sides. I mean, if as an investor I mention that this is an area I would help you with, it will only get revealed, or it will only become clearer once that investment has happened, and once I'm in the business. Similarly, if I feel the brand is extremely strong today, and there is enough certainty that I would be able to convert this brand equity to sales, again, that will only be known once that business starts investing capital, and it gets onto that trajectory. So these are intangibles that need to be thought of, and also given some some significant value uh, when any transaction is ensuing. So I think this is my last slide, and as I mentioned, finance folks, I am not too sure if that's the right term, but this is a term that is sorry, this is a quote, and obviously I'm sure you might have heard of Warren Buffett, but this is a quote that has been said umpteen number of times. I think I've heard it multiple times, being quoted by people across the globe. But this is critical, and this is really true. Today, how investors think of a business, and that's where I would recommend that entrepreneurs also think like investors, at least when they're fundraising, is that if I'm going to pay a certain price for this business, what is it that I'm going to make? Uh, as because once I'm paying this price, I have a cost, I have a lot of risk, I have a downside. So today, and in our jargon, we call it intrinsic value. What I mean by that is that today I may be paying, say, X, $100 for something, but if there is a lot of economic benefit attached to it, maybe in the years to come, I may be able to harness value which is worth 300. Now that's where, I'm paying a price to harness that value. So price, and again, the reason I put this out is, to be honest, because we do get you know questions or concerns or thoughts that, oh, is my business worth this only, or is my business not worth much more, 100% more, 200% more? And that's what I'm just putting it out. There's a difference between what is price and what is value. So today, yes, it's not the value of your business, it's the price someone is paying to harness a certain value. Tomorrow the value of your business actually may be 200% more, which will manifest over time. So there's a difference. So when you equate these two, you may end up either disrupting the exercise, or um, not, I mean, conducting not the best deals. So it's important that you keep this in mind. And I think this is my favorite picture, and hence I keep it. But I think, yeah, that's about it. Back to you, Minnie.
Thanks so much, Mihir. That was very interesting, I must say, and it gave us a basic understanding of what value and valuation is. I have a question for you now. You talked about the top down and the bottom up business models, right? Now, is
Mm-hmm.
there anything specific industry wise when you talk about a specific industry? Is there, would you say that a certain type of model is what one should follow in a particular industry? Is there anything like that?
So at least, so for most of the industries, like I would tell you, many is we do suggest a top-down model, essentially because, like for instance, if I'm a consumer brand, I'm starting a business in, consumer packaged goods. Now today, if it's a new category, it may be difficult to understand what my addressable market is, uh, and I can take a certain universe to be my market. But what happens is that when I kind of understand that this is the kind of market share I want to occupy, and then these are the requirements that I need to invest in order to get that kind of market share, you are what you're essentially doing is you're capturing a certain market growth and you're capturing a certain market share. So for more often than not, if it is a possibility, then we do recommend that you go by that approach. However, sometimes you may come across products or services which may not find a parallel, right? So it may
Right.
be a actual disruption. So as we were talking previously, just giving an example, when I look at plant-based foods as a category today, now it's a new category, it's emerging. So it's kind of difficult to say that there is a certain market which already understands that product and buys that product and so on and so forth. So now if I'm a company which is manufacturing plant-based, can be anything, any product, I may see exponential growth, once I've invested capital, because it's difficult to fathom exactly what my addressable market is. Maybe 10 years from now, it will be easier and there will be something else. So where there is
Right.
complete ambiguity in terms of creating a parallel, yes, you can go by certain, understanding of how you've seen your business grow or how you've seen in the past customers coming in, repeats, and so on and so forth, and then project your business accordingly. But if it's a particular space where you can draw a parallel, going by that top-down kind of thought process really helps you also to keep a track on how am I progressing as a business.
Right. So in the going by the same thing, if you're a disruptor in the market, or if you're doing something which is completely out of what out of the ordinary, if I can say, you talked about benchmarking for the valuation. So
Hmm.
that also, I guess, would not really be possible, right?
Yes, so that becomes a difficulty. See, obviously, especially when it comes to disruptions, because there is no price discovery platform today, or it's difficult to put a price to, like, we've seen businesses which are doing something completely different and something that has not been. So let's look at Tesla, for instance, right? So when Tesla came out with electric cars, it was a disruption, it was one of the biggest disruptions this planet
Right.
has ever seen. Um, Now, that point in time, it's difficult to say what Tesla should be valued at. Yes, but in those cases, I think the idea that an entrepreneur, in my personal opinion, should have is that when it's a disruption, it needs that validation. It needs number. It needs to become a business. So a lot of times we see innovations not really becoming businesses. So for that point in time, I think valuation, what takes precedence over valuation should be the validation of the product or the innovation or the
Right.
disruption. Today, what we see Tesla and what Tesla's value is, I think 15 years back, no one would have imagined, or whatever
Yes.
time period back, no one would have imagined Tesla would become this. But it has discovered value in a certain manner. At that
Right.
back in the day, I think what was important for Tesla to prove is that this can work, and they proved it, and that's important, I think.
Right.
So yes, it may become difficult, but I think overall idea should be to prove validation first.
Right. Right. Now, I would like to take a look at, we've got a couple of questions here. And in fact, it's related to what you were also talking about, the tangible or the intangible aspects that one should look at. So we have a question that says, has the way business is valued changed, keeping in mind today's scenario? So I think the intangibles, especially in today's scenario, becomes all the more
Yeah,
important.
all the more
Am I
important.
right in saying that?
Yeah, absolutely. I think so. I would take two perspectives. I think from a founder's perspective, yes, when a founders today looking at valuations, the perspective changes that yes, they require more intangibles and they require to understand. See, a lot of businesses went through a phase where capital was in scarce supply. There were blockages to businesses, and they've gone through a certain challenging phase. So in these phases is where you test the other intangibles that an investor brings in, like the willingness to support the business, the thing to ensure that business still comes out of where it is, and we can still survive and so on and so forth. So I think today founders are definitely looking at more intangibles and not just that, okay, this is the capital coming in, this is the valuation I'm getting, and that's it. So they want to understand what kind of strategic benefits can an investor bring in. Um, what is the long-term vision of the investor himself, so that they are aligned or not aligned and things like that. So it's not just about capital, but it's that entire alignment. And from an investor's perspective, I think um, what has happened is that there's been a complete change in terms of, obviously, there's the propensity to build risk into the pricing. So hence we've been seeing valuations take a massive hit uh, across the board. I think across sectors is because factoring in that risk in the entry point itself, so that you kind of protect your downside going forward, um, has definitely been on the high. So investors do want to protect their downside, and as I was mentioning in the presentation, it can happen in one of two ways. That one, your entry point is attractive, so the price I'm entering in is good enough for me to protect that downside. And I think the second is, okay, if you know should I reduce my exposure to the business? So if an investor may be looking at, say, investing X, should I not start with X, but should I start with X minus minus and then notch it up? So yes, the idea of valuing risk factors is actually higher, is what we are seeing, and they want to ensure that most of the risk factors are built in while when they are entering a business.
Yeah. So I think related to that is a question specifically talking about the F&B industry, that in that case, when investors are, there is a little bit of hesitation from their side. So would that mean restaurants without a strong delivery revenue at this point of time change the dynamic of the valuation, even if the brand has considerable value?
Yes, I would say yes. I mean, it may sound like an aberration. Obviously, see today, the hard truth is that delivery is an important, or I think it's a critical element in the food and beverage industry. Um, you just can't escape it. So whether you choose a Swiggy or some other platform, that's a different question. But escaping that trend that has come in, or certain trends that have come in, is difficult. Now, obviously, today there is a lot of ambiguity, and specifically to F&B, I think there's a lot of ambiguity as to how will the next few quarters be. Um, and I think so. There are now two ways an investor would look at it. One is that, okay, look, let the tide pass, or let the storm be over. We'll think about it then. So let these few quarters pass, and now the business may survive that time, may not survive that time, not too sure. But that is one way an investor may look at it. And the second is that, look, we understand that these next few quarters are going to be difficult for the restaurant industry, essentially because not certain if the consumer confidence is back, not certain if people are going to replace eating in their houses and going out frequently, not certain as to how workplaces will be in the next few quarters, because as you understand, a lot of actually food places, restaurants run on professionals, and so a segment has actually gone out. So they may be like, okay, look, we don't know how the 6 quarters or seven, how many quarters are going to be. So let us build that into the price we're entering at. Or, we don't invest at all. We just keep the exposure zero. And once this storm is over, then let's look at it. In either case, yes, that hit will be there. And that's why I think delivery is critical. And just as I mentioned, it will impact your valuations if it's just one channel kind of a thing.
Right, right. No, it is a fact that unfortunately the F&B industry has been hit very badly. But we are seeing, I mean, I would want to end this on a negative note. We are seeing things getting a little better, people opening up, restaurants opening up,
Yeah.
people being more open to going back to restaurants. So let us hope that, things can come back to the normal, I would say, and become good again for all of us. who are part
Oh,
of this industry.
absolutely.
Yeah. So,
Absolutely.
so thank you so much, Mihir, for your time and your insights. I'm sure this would make a lot of difference to the people who are actually looking at this point of time to, approach investors or anything, and to get an idea of what their businesses are like in terms of value and valuation. And thank you for your time. We look forward to having you on our physical show when we come back
Oh,
to,
absolutely. I think
getting
that will be a
back
delight.
to doing events the way we've known it.
Yeah, no, that will
Yeah.
be a delight for
Thank you.
sure.
Thanks
But
again,
thank you so
Mihir.
much, Winnie. Thank you, everyone.
Okay. Bye bye.